Hello, trader friends. Welcome to another episode of Uncle Tony's Trading. Today, I have a very exciting episode, and I think a lot of you need to go back to fundamentals, to your basics of trading, because I see a lot of mistakes. I see a lot of questions about using options correctly. As everybody knows, we have two types of options, calls and puts. And today, we're going to focus on the puts. What are they? How you should use them, what is the right way to use them, and what is the wrong way to use them. So, without further ado, let's get to it. Now, on the puts, you can either buy a put or you can sell a put. And Tasty Trade released an unbelievable option strategy cheat sheet. Go to the Tasty Trade website and download the cheat sheet for free. And we're gonna go through the cheat sheet today a little bit and explain to you guys what is a put, what is a long put, what is a short put, what is the correct way to use a put, etc. So the dictionary, the formal definition of a long put is a long put gives you the right, but not the obligation, to sell 100 shares of the asset of the stock at a certain strike before an expiration date. Now, what the hell does this mean? For example, you bought a stock for $80. Now that stock is at $120. So you're up $40 on your stock. And you're afraid that you might lose some of those profits. So one way that people use put options, correctly or incorrectly, we're not judging right now, is they would buy a maybe 100 strike put or 110 strike put to protect the gains that they have on that long stock that they have. So what happens? You go, you buy that put, and hopefully, if the stock goes down, you're protected because you have this right to sell your stock at that price. If you bought the long put at $110, then you have the right to sell your stock at $110. But like everything, nothing is free in this life. So that right to sell cost money, cost dinero. So, there's no free lunch. Also, if the stock starts going down, of course, the put option might gain in value and then you might profit with your long put option. And take a look at this little chart that we have here. Here you can see that, you know, of the maximum profit you can have on a long put is basically unlimited, but unlimited to zero, because normally stocks don't go down more than zero, because zero is the rock bottom, right? And a lot of people gravitate to the long puts. Why? Because long puts have cost a fixed cost of one, two, three, five, $10, $20, and that's it. That's the maximum amount you can lose. And that's another reason why people really like buying long puts. Now, this is a chart that's not as fancy as the Tasty Trade cheat sheet, but it's my little cheat sheet that I create myself to remind me what happens when you buy puts. So take a look at the green section here. If you're buying a put, you must be bearish. Why? Because that put option only benefits if the stock goes down. It also has negative theta. What does it mean? It means that if the stock doesn't go down fast, you will lose money every day. And you will start losing a little bit of money every single day until the amount that you paid for that long put disappears. And that's called negative theta. Imagine you paid $1 for a long put. So every day you might lose 4, 5, 6, 7 cents every day that the stock doesn't go down to your strike price. And that is no bueno, no good. Also, a positive of buying long puts is that they, like I mentioned, they have unlimited profit, of course, all the way to zero. Another good thing that attracts a lot of people to long puts is that they have a limited loss. They say, okay, I'm going to spend 100, 200, $500 on this long put, and that's all I can lose. And a lot of people are very attracted to that. And another huge, humongous, terrible negative of buying long puts is the very low probability of success. Why? Because sometimes people ask me, hey, Tony, the stock went down and I still lost money on my puts. Yeah, that's the crazy thing about buying calls or buying puts. You can be right directionally and still lose money. Why? Because the stock didn't move down as fast as you needed it, or it didn't move down to your strike price also. So if the stock doesn't move to your price or moves down fast, you might lose money by looking spending money on long puts. Now let's take a look at a real trade, at a real example. So here, for example, we are Tesla. Tesla today is having a rough day, although it has rebounded from its low today. So if you had Tesla long stock and you wanted to protect Tesla from not going below $145, you would buy this 145 strike put. Here, as you can see, it cost $3.85. Now, if we go down here to the bottom left, you see that this long put has a maximum loss of $385, which is the debit that we're going to pay. Remember, one put equals 100 shares of stock. So one put equals 100 times 385. That means it's $385. Now, if Tesla goes to zero, we will profit $14,115, which is the maximum profit we would make if Tesla goes to zero. Tesla right now is here at $167 the moment we're doing this trade. Now, the probability of profit of this trade is only 22%. Whoa. So, yeah, it's a cheap protection, but we have only a 22% chance of making money here. It also has a negative theta. Here's what I was telling everybody: you are going to lose $9.72 every single day that Tesla doesn't go down fast, or it doesn't go down to the 145 strike. Also, if Tesla doesn't reach your strike price, you will lose money. And here's another interesting fact. So even if Tesla goes to 145 dollars, you paid $3.85. So you actually need Tesla to actually go down to 145 minus the $4 you paid. You actually need Tesla to go down to $141 just to break even. And of course, after that, it's all green pastures, and you start minting money if Tesla stock crashes. Another important factor to consider if you are wanting to buy a long put, you can see here Tesla 165 is the at the money price. So if we choose the $145 strike, it's costing us around $3 to $3.90. If you want to spend less money, let's say, oh, I only want to spend $60, Tony. So you would buy the 115 strike put, and you would only pay about 63 cents. But take a look at this. So you're only risking $63, but then the probability of profit of your put goes down from 22% to 3%. So you can you can decide to spend less money and buy a cheaper put. But if you buy a cheap put out there, of course the probability of you making money on that put really gets decimated. Now, another factor is how much time does that put have to live? This put, we chose the May 17th. It has 45 days to expiration, and that's take a look at the 145 strike. The 145 strike is around $3.90. If we go to the April expiration with only 17 uh, days left, the 145 strike put is now only worth 81 cents. Wow. So something that we paid 390, if nothing happens, and you know It's now it's only 17 days left. Now the price is only 89 cents. If we go down to April 5, the 145 put now is worth a measly 5 cents. It's worthless. It's nothing because now the probability is below 1% and Tesla goes to 145 in one day. Now, it could happen. I'm not saying it can't. Anything's possible, but the odds are not on your favor. Now, if you want to give yourself more time and you say, okay, Tony, I'm going to buy maybe the September 145 put, guess what, trader friends? Now you're going to be paying $11 because the more time you want to be right, the more you have to pay to play for a longer period. So you see, we started at 45 days, we paid around $4. And then at 17 days, it went down to 80 cents. To 3 4 days, it went down to 5 cents. And if we go 171 days to September, now we're up to $11. So that's another factor for you to take into consideration. Not only the strike price determines the price of the option, but also the time. How long do you want to keep that protection or that bet that the stock goes down? If you want if you want more time, it's going to cost you more money. If you want less time, it's going to cost you less money, but you're going to have less time to be right. Now, as a summary, a long put is a bearish strategy. You want the stock to go down. Remember, it gives you the right, but not the obligation to sell that stock. Also, a put option can increase in value if the product goes down. But if it goes down fast and if it goes down to your strike price, you can profit if the stock starts going down after you bought your put and the value went up. I would take advantage and maybe close that put because that put, remember, has a low probability of making money. And why not take your profit? You can also lose money if the stock doesn't go down fast and it doesn't go down to your strike price. So remember, and if the stock goes down, but it didn't go down to your strike price and time expires, that means the clock is ticking when you buy a put option. Tick, 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 tick. If it expires and the stock didn't reach your strike price, then boom, that put option is going to end up worthless. And remember, you're going to have negative theta. That means you're going to be losing money every single day. So does Uncle Tony say do not buy long puts? I'm not saying that. I'm just saying if you're going to buy a long put, know why you're buying it, know how much you're risking, know that it's a low probability trade, and be be aggressive. If you're right and you got lucky, take your profits. Take your profits because maybe those profits will disappear fast if the stock rebounds. Alrighty. Now let's take a look at the short put. As you know, short puts are one of my favorite strategies, are one of the best strategies that I think you can do as a trader. And let's take a deeper look into it. Now, one of the main difference between buying puts and selling puts is if you sell a put, you sell a put. I'm going to repeat myself. You sell a put, that means you're bullish. If you're bullish, you want the stock to go up. If you buy a put, you're bearish. That means you want the stock to go down. Please memorize these concepts as are they're very important. Now, when you sell a put, guess what? Time is on your side. Every day the stock doesn't crash. Every day the stock doesn't reach your strike price, you make money. So that theta that the guy who bought the put is losing, you are going to be making money because it has positive theta. Now, of course, there's no free lunch, trader friends, and selling a put has an unlimited loss. Unlimited loss, of course, to zero. Like Tesla. Tesla's $165 now. If Tesla goes to zero, that's our stop loss. But it's a lot of pain from 165 to zero. So if you sell a put, then you know that your maximum loss is to zero. And the reverse of buying a put has a low probability of success, and selling a put has a high probability of success. Now, regarding the profit, here is why a lot of people don't like selling puts, but I love selling puts because selling puts has limited profitability. Everybody wants unlimited profit. Everybody wants to make a lot of money. So when you sell a put, the maximum amount of money you can make is the credit you received for your short put. Here, take a look at my little chart. So let's say the stock is $100. You sold the 90 put. The maximum profit you can make is whatever credit you got for selling that specific put. For you guys that like a more formal explanation, I'm putting up again the Tasty Trade option cheat sheet. And here we can see that a short put is a neutral to bullish strategy. It involves selling a put option at a strike below the current price that the stock is trading at. And also, there are other names for selling a put. It's called a bull put, a naked put, uncovered put, or a short put. I like to call it just a short put because a naked put sounds very I don't know. Maybe the YouTube algorithm will block me. Who knows? But that's what I like to call it. Furthermore, we can see that the option, like I was saying, the put option has a maximum profit of the credit received. Also, for example, if we collected $2 for the short put times 100, that means the maximum profit for our put is going to be $200. And of course, the break even for our put option, if we sold the 90 put and we collected $2, then our break even is going to be 90 minus the $2 that's already in our pocket. We already collected that money, so nobody can take that money away. And we will start losing money at 90 minus the $2 we received for that put option. So that takes us to $88. Now let's take a look at the Tasty Trade platform and see a real example. Now let's take a look at the Tasty Trade platform to see some real examples of real trades, of real trades showcasing a short put. So, I like to sell puts 45 to 60 days out. Just happens that May 17 is 45 days out. You guys know I like the 20 to 30 delta or the one standard deviation. Here we can see that once again, instead of buying the 145 put, what I'm going to do is I'm going to choose and sell the 140 put just to make it a little different. And we're going to collect $3. And this $3 is going to be our maximum profit. The maximum profit we can make is $300, but we have a maximum loss of $13,700 if Tesla goes to zero in the next 45 days. Tesla can go down, but go down to zero, I don't know. That's hard, but anything's possible. This trade has a probability of profit of 81%. It has 89% probability of making 50% on our profit, and it also has a positive theta of $8.73. That means that for every day that Tesla doesn't reach our strike, we're going to be making $8.73. Now our break even for this trade is going to be 140 minus the $3, so we will not lose money if Tesla goes to $137. Now let's take a look at it graphically. Here we can see what's going on. So Tesla is right here at $165 right now. Our put is way down here at the 140 strike. We're collecting $3. And as you can see, as long as Tesla stays above the 140 line, we're going to make our 300 buckaroos. Now, another huge difference for this trade. This trade requires a lot more capital than buying the put. Why? Because this trade has a lot of undefined risk. That means Tesla, you can lose your shirt if Tesla starts going down. So in the long put, your maximum risk was the debit paid, which was the $400. Here, in my platform, I'm only using $3,000 of capital, but that varies depending everybody's type of account. If you want to be more conservative for this type of trade, you're probably going to be using a lot more than $3,000, maybe $6,000 of capital to put on this trade. Why? Because it has undefined risk, and Tesla could potentially go to zero. Now, you see, that's a huge difference between selling puts and buying puts. One has a very large uh, probability of success selling a put. It has a very small profit amount, which is the credit received, and it has a very big probability of success. And very similar to the long put. If we want to, let me clear this out. If you want to collect more money, what do you think you have to do? If you want to collect more money, you probably have to go to July, August. So for the same strike put you see here, we can collect $654 here. The more time we give the trade, the more credit we will be able to collect. And of course, if we sell this put with only 3 days left, we're probably only gonna collect peanuts, which is not really worth it. So in a short put, my sweet spot is selling 45 to 60 days out, and my sweet spot is selling the 20 to 30 delta, or the one standard deviation. That is what I do for myself. And also, I have another great video of how to create some passive income by selling year out put campaigns on the S&P 500. So don't miss on that video, because I that video explains clearly what I like to do for my account and also for my children's account. To summarize, selling a short put is a bullish strategy. It's a strategy that can be profitable in many scenarios. If the stock market goes up, you're profitable. If the stock market goes up a little, you're profitable. If the stock market stays flat, you're profitable. If the stock market goes down a little, but not enough to reach your strike, you're profitable. So, 4 out of the 5 ways to make money, you will make money. You only lose money if the stock goes down fast and it goes down hard to your strike. Another sometimes negative thing is that the profit that you will make is a fixed amount, is the credit received. Also, another negative is that you have unlimited risk to the downside, especially if the stock goes down. Also, margin can increase. The initial margin required by your broker for to place the trade could double or triple if the VIX explodes and goes up. So that's another negative. And so you can incur in large losses by selling puts. I like to sell puts on down days. I like to sell puts, for example, on Tesla today. Tesla had a bad news day, and Tesla's been on a down move this year. So a lot of the bad news in Tesla is already in the stock. Of course, it can still go lower, but to me, that's a reasonable risk reward. I like to sell puts on down days. I like to sell puts when VIX explodes up, and I like to sell puts on stuff that I want to own and I want to buy. So a very simple strategy, like a put. It's a little more complex than you guys think. You can buy puts, you can sell puts, you can buy puts further out of the money for a lower debit amount, but for a lower probability of success. You can buy puts higher up, closer to the money, for a lot higher debit and a higher probability of success, but with much higher negative theta. Same thing for selling puts. You can sell puts, at a 16 delta, 20 delta, 30 delta. You can sell puts at the money. And if you want to collect more money, selling puts, as we described, has 4 out of the 5 ways that a stock moves that we can make money. It's a high probability of success trade, but the negatives, of course, margin can explode and your losses can be huge if the stock plunges and goes down hard, and VIX explodes and the price goes down hard. So in trading, there is no free lunch. You must know when to be using each of these strategies, when to buy a long put, when to sell a long put, and the risks that you're taking by executing one of those two trades. If you want to learn how to trade, follow Uncle Tony. If you want to make money trading, I would say, hopefully, follow Uncle Tony. Of course, this is not a guarantee or anything, but I've been doing this for more than 20 years successfully. And if you want to grow your pile, remember, you got to risk it to get the biscuit, baby.